Hi friends, welcome to the NPTEL course Strategy and Technology, a practical primer. We are in week 12 with the theme of Technology and Strategy case studies. In this lecture, the 58th in the series, we discuss the case studies of GE and DuPont. These are two global industrial corporations. They represent America's great industrialization. They have a hoary history of over a century each. They demonstrate how early industrial innovations established businesses that grew on further innovations, and of course, significant amount of management input. GE was founded on Edison's famous invention of the first commercially practical incandescent lamp, or the electric bulb as we call. From then on, electric powered its innovations. GE over the decades combined strategy and technology to become a diversified global conglomerate. Its innovation engine may have stuttered but sustained. DuPont is another case study. DuPont pioneered multiple material technologies that served as platform technologies to power in turn a number of products over the last several decades. DuPont also pioneered integration of environment, health and safety into design and manufacturing of products, and also as a standalone role model practice. GE and DuPont demonstrate that even traditional industrial product and service companies can grow to perpetuity based on innovations. Both the firms are now focusing on digital innovation to strengthen their innovation engines. However, in respect of GE, there could still be some discussion as to a different strategy would have ensured GE to stay as competitive as it was and remain as one integrated conglomerate. General Electric was founded in 1892, and one of the five founders was Thomas Edison, who has invented the electric bulb. It was headquartered in Massachusetts, US. Revenue as of now is $80 billion, net income $5.7 billion. Publicly listed company with over 205,000 employees across the globe. Plants are situated in several parts of the world. Market capitalization is $112.98 billion. Once upon a time, its market cap exceeded $500 billion US. The products are aircraft engines, electrical distribution infrastructure, electric motors, energy, finance, healthcare, software, and wind turbines, to quote a few. GE exemplifies the history of innovation and the great American industrialization. Between 1879 and 1969, it laid the base for several industrial innovations. Edison invented the first commercially practical incandescent lamp in 1879. And GE put electricity to work on a large scale in 96-ton electric locomotives in 1895. And GE was one of the pioneers getting into medical imaging. GE also went into household requirements. GE improved life in the kitchen with the first electric range. The ductile tungsten filament, which was invented in 1908, continues to be used even today. Voice radio broadcast was made possible by Alexanderson's high-frequency alternator. There are several innovations of GE that powered the period 1879 to 1969. The new X-ray machine, home television reception, silicones chemistry, invisible glass, low-pressure discharge lamp, first US jet engine, the laser light, and the list could go on and on. Between 1971 and 2015, the industrialization, the technological innovation was combined with high-speed business diversification and globalization. So turbofan engines, Sigma magnetic resonance imaging system, Mars observer for NASA, sustainable energy, CT scanner, fuel-efficient locomotives, ultrasonic TMDO, high-speed gas engine technology, next generation jet engine, watt station charging electric vehicles at home or on the road, V-scan, next evolution of power devices with silicon carbide technology, largest and most efficient heavy-duty gas turbine, and heavy-duty gas turbine with using FastWorks methodology. These are all more recent innovations in GE's checkered history. But then there were twin ironies of GE. Jack Welch, whose tenure between 1981 and 2001 at GE was synonymous with great leadership, did not leave behind a lean, sustainable conglomerate. He is credited with the scores of acquisitions which made Jack Welch a legend, as well as GE, a global conglomerate. Getting GE into capital business has been one of his hallmark decisions, which proved itself well during his tenure. However, as industrial situation turned more competitive and as capital markets turned volatile, GE Capital was buffeted from several fronts. The main issue was that Jack Welch failed to envisage the risks of a conglomerate, and he could not lay a new strategic vision wherein GE needed to be ahead in an Industry 4.0 situation driven by digital, biological, and electromechanical fields. That's where the vision was not laid in the proper manner. GE was a pioneer of the GE matrix for prioritization of business portfolio. We have studied that in my earlier lecture. He also advocated sound capital budgeting techniques. However, GE failed to apply its matrix to its own disparate business portfolio. The businesses and the products became too unwieldy even for a conglomerate. If you see the revenue and earnings chart here between 2001 and 2011, as well as later on to 2021, revenue has taken a big beating. $125 billion moved up to $142 billion in 2011, probably the peak period, and then declined sharply to $76 billion. Earnings increased from $31 billion in 2001 to $35 billion in 2011, but plummeted to just $0.4 billion in 2021. Debt was $450 billion in 2001, but through spin-off of several companies and several businesses, the debt was paid down to 133 and 51 respectively in 11 and 21. Market cap, one of the biggest indicators of the happiness of stock markets on a particular company, plummeted from $400 billion to $100 billion in 2021. That has been the fall of GE over the years. GE always had strong leaders, but the sustainability of the corporation itself was weak. Jack Welch was the legendary CEO of GE between 1981 and 2001. He has written many books, and many books have been written about him, his style, and several of his practices, from Six Sigma to Dedicated Management Center, and from having the bottom 10% of the human resources getting weeded out based on performance, and the dilemma which he promoted, but with success, of closing down certain units while investing aggressively in certain other businesses. He was a legend in his time. Then Jeff Immelt followed it between 2001 and 2017. He tried to follow the path laid by Jack Welch for some time, but then realized that the company was becoming a behemoth, far too large and far too diversified to be of comfort. So he began the slimming down of GE as a corporation, but he wasn't completely successful. He had a follower, Jack Flannery. He lasted just 2.5 months. Now it is left to Larry Culp to restructure GE. He has taken over as the chairman CEO in 2018 and continues to be at the helm. Under chairman and CEO Jack Welch, GE became a large, singular, leader-driven conglomerate of multiple businesses. You think of a business, GE was there. GE represented the highest level of technological development, operating in high-end medical imaging, high-end energy equipment, high-end space-related equipment and infrastructure, high-end home appliances, you name it, GE had it. And that was the level of diversification. But GE getting into finance was another landmark move by Jack Welch. Probably it went out of control as the global liquidity markets got buffeted by various other parameters. Jeff Immelt, his successor, tried to make the unwieldy conglomerate, as I said, leaner, but there was very little success in terms of the financials. It is now left to Larry Culp to restructure GE. We will see how he is trying to restructure as well. Jeff Immelt, who took over as the CEO after Jack Welch, spent over $175 billion across 300 M&As, though such behavior would yield diminishing returns in the post-Welch era. Welch himself was credited to have done close to 1,000 M&As during his period. GE was competing with many firms that were emulating its myopic strategy, driving acquisition prices even higher due to increased competition. So it was self-defeating strategy. GE wanted to acquire anything at any cost. GE's slight and subsequent recovery from 2003 to 2007 was short-lived. A global recession once again caused its market capitalization and stock price to plummet. GE's outstanding debt peaked at more than $500 billion in 2018. Over the course of the financial meltdown, GE's stock price fell from a high of 42 in October 2007 to less than 7 in 2009-10. To remain competitive, GE outsourced its manufacturing to South Korea and tried to reduce costs. This technology transfer provided Asian companies with an opportunity to understand and absorb GE technology and introduce lower cost comparable products, of course, with their own technology. This left GE scrambling in the market because they never imagined that their loyal customers would leave their brand and go in for Korean brands. During his time, Jeff Immelt did try to make GE more agile and more capable. So he engaged Eric Rice, who was famous for his startup movement. Eric Rice, as we know, authored the bestseller called The Lean Startup. FastWorks is a program at GE that is based on principles from his book, and the methodology aims to shorten product development cycles by eliminating waste and focusing on quality and cost control. In 2012, GE had a broad, very diversified portfolio, and it lacked asset efficiency. Its non-industrial businesses were low technology businesses. They were slow to innovate, and the business units operated in silos. GE's strategy was to be an efficient and lean company and become a leader and continue to be a leader in the industrial conglomerate space. However, its market share, sales and profits collectively as well as from the individual businesses' point of view were declining year over year. This obviously triggered the need for change, and he tried to adopt the lean startup inspired program FastWorks and divest slow, inefficient and non-industrial businesses. To align its vision and mission, GE developed a strategy that was focused on customer and continuous innovation. This happened during the Jeff Immelt times. Before FastWorks implementation, there was this very siloed structure and no alignment existed between the functions. He established Global Growth Organization called GGO, which expanded GE's presence in emerging markets, created horizontal operations with shared P&L responsibilities. Before FastWorks, all decisions were made by a centralized corporate executive team, and that was moved into a more decentralized decision-making framework, and local market conditions were being taken into account. The process and policies at GE encouraged a waterfall methodology, whereas FastWorks processes and policies promoted an agile methodology that inculcated a highly iterative and scientific approach to product development. GE lacked the agility. It was innovative once upon a time, but the innovation in the 1990s, 2000s and subsequently required agility as well. Amazon and Facebook represent the kind of agility that was demanded of technology companies. GE tried to develop faster go-to-market capabilities under the FastWorks implementation, started to collect customer feedback and modify products accordingly, and make the products future ready. In terms of leadership and talent, The leadership at GE prior to 2012 was top-down, and Jack Welch towered as a leader over and above anybody else. FastWorks encouraged GE to have a top-down as well as a bottom-up leadership. Before FastWorks, GE innovation was very predictive, in a way linear innovation, and no encouragement was given to customer-focused product evolution. It was technology-driven. After FastWorks, GE planned to adopt a culture of failing fast and early so that the resources can be optimized. The culture also developed teams that could collaborate more effectively with customers. In respect of technology, most of the innovations from the early 2000s were focused on consumer and communication technologies, but specific products were slow to come up. GE began to develop and install sensors within all their devices. This is something which Jeff Immelt believed very passionately. He felt that by understanding the performance of the devices, equipment in different fields, GE would be in a position to develop better customer service as also develop more futuristic product range. However, this technology was not brought in at the right time and also in the required pace. Performance metrics: GE before FastWorks were rewarded for risk aversion, and on delivery of promised outputs ranked high on the agenda for rewards. The organization was more managerial or bureaucratic, as one may look at it. After FastWorks, performance metrics of employees were made more customer and product focused, and this helped promote a culture of innovation. As you can see, GE recognized the need to change culturally, administratively, and technologically. However, the changes started coming too late and also in too slow a manner to be making GE competitive in the hyper-competitive world of the 2010s and 2020s. Under Jeff Immelt, GE retained some businesses but sold some businesses too. Power and water were rebuilt and diversified after the power bubble. Oil and gas systematically built a franchise position for growth. Healthcare, broadened healthcare diagnostics franchise beyond US was developed. It included life sciences and healthcare IT. Aviation was expanded through acquisitions based on systems and supply chain. Energy management was invested in for adding scale to the business. All these businesses attracted investments from GE leadership. The disposals were media, repositioned NBC Universal and divested at a good return. Plastics, silicone and security was sold as it was not considered core to the infrastructure portfolio. The appliance business was sold because it did not enable technological and global growth. It was an admission that GE would not be as nimble and as modern as the Korean competitors or even the Chinese competitors. Insurance business was sold to reduce the risk before the insurance storm and the liquidity storm took over. Consumer finance was moved out because it lacked GE competitive advantage. GE Capital became a kind of pale shadow of itself. You can see GE's stagnation in recent years despite all these actions. From $100 billion turnover, it has come to $80 billion turnover. While there has been some improvement in profitability in 2020, you will find that it posted successive years of losses in 2017, 18 and 19. Investors were unhappy with General Electric. GE had been struggling from the time the financial crisis of 2008 dealt a body blow to GE Capital. GE's deep connect with the fossil fuel industry also queued the pitch further because the massive investments that would have happened had the fossil fuel industry grew as it grew earlier were not forthcoming anymore. So GE's industrial orientation suffered a deep setback. At its height in early 2001, GE was worth more than $500 billion. It made GE the most valuable company on the planet at that time. Now what is left of the company is worth just $100 billion or only 23% of that formal value. GE had a series of divestitures. During Jeff Immelt's time, and since Lawrence Culp took over as the CEO of GE, the company sold off assets to cut costs and lower debt. First, it sold off its Star Appliances business to Chinese household goods manufacturer for $5.4 billion. It even shed the iconic light bulb unit in 2020. That was the heart and soul of GE for several decades. In March, GE sold off Jackass, the aircraft leasing business that was part of GE Capital, to AerCap, an Irish company. The list of divestitures is actually long, too long to be covered in this lecture. Now GE has decided to split itself into three companies: aviation, energy, and healthcare. And the idea is to spin off the energy and healthcare ventures with some shareholding by GE still, and keep aviation as the core and center and the whole of GE. Larry Culp, CEO Chairman, said, by creating three industry-leading global public companies, each can benefit from greater focus. Each will have tailored capital allocation strategic flexibility, and this will drive long-term growth and value for the customers, investors, and employees. And he believed that he would be putting the technology expertise, leadership, and global reach to work to better service our customers in its new avatar. So let's look at the health. GE's futuristic innovations are essentially in terms of precision health. That would be leaving GE fold in early 2023 with a stake of around 24%. What GE Healthcare tries to do is blending of the physical and digital worlds, improve diagnostics, and make precision healthcare commonplace. As we have seen from the timeline chart, GE was a leader in healthcare diagnostics, including medical imaging. Photon counting CT would further improve the clinical capabilities of the traditional CT, including the visualization of minute details of organ structures, improved tissue characterization, more accurate material density measurement, and lower radiation dose. GE Healthcare's Edison digital health platform aggregates clinical data from various sources, including clinical devices, allows Edison applications to generate insights by applying advanced analytics and AI across the care continuum of screening, diagnosis, therapy, and monitoring of diseases. They analyze through high-resolution techniques brain and identify the causes and triggers for a stroke. They detect cancers. They help doctors predict which way patients should be prioritized. So precision health is an important aspect of modern healthcare, but GE probably lacks the biological edge which the startups provide. So GE has decided to spin it off, the equipment-oriented, the technology-oriented healthcare business, for inducting better capital and better technology. In the field of energy, GE wants to combine traditional power, renewable energy, and digital, and this also will be spun off in 2024. GE will hold about 24% stake. This business certainly possesses a unique offering because renewable energy is the way to go in future, and to be able to do that, a solid foundation in the traditional energy also would be helpful. So modernization and digitization of the grid would be an important aspect of GE's energy business. GE's Haliade-X offshore wind turbine was engineered to evolve with demand. The initial model produced 12 megawatts a year ago, which is now raised to 14 megawatts. New generation gas turbines, which run on a blend of natural gas and carbon-free green hydrogen, and which uses renewable electricity to split water molecules and produce oxygen and hydrogen, are under commercialization. The core business would be aviation. The GE, as in its new avatar, will be focused on aviation. The future of the flight here will include hybrid electric planes, alternative fuels such as 100% sustainable aviation fuel and hydrogen, as well as digital technologies that will help the industry become more efficient and sustainable. GE has a joint venture with Safran aiming at advanced technologies for the next generation of multi-fuel engines. This could ultimately lead to engines that would use 20% less fuel and produce 20% fewer CO2 emissions compared to the most efficient jet engines built today. Just in time for the COP26 conference that was held in Glasgow, in November 2022, a long-haul Boeing 787 flight from London to Abu Dhabi scored a 72% reduction in carbon emissions using the existing technologies. The plane was powered by GE Aviation's Gen X engines. It used GE Digital's Fuel Insight software to analyze data and make fuel-saving adjustments within minutes, and also used GE's innovative 360 foam wash, a cleaning system that can help improve engine performance and reduce fuel consumption. It removed dust and dirt from inside the engine for optimal fuel efficiency. So GE is firmly believing in an aviation future. Now let's come to DuPont. It is another great company. It was founded in the chemicals industry in 2017. It got merged in terms of Dow Chemical and EI DuPont Emerson Company recently. Headquartered in Delaware, USA, with revenue of $20.4 billion, but it sustained losses of $2.95 billion as well, like most of the other industrial companies. Publicly listed company, 98,000 employees, worldwide plant print, and market capitalization of $42 billion. Its products are in terms of construction materials, fabrics, fibers and nonwovens, packaging materials and solutions, personal protective equipment, solar photovoltaic materials, just to quote a few. This is the timeline between 1802 and 1809. Founded in 1802 with just 36,000 in capital, it has become a multi-billion enterprise. It started its life in explosives. I had the pleasure and privilege of visiting DuPont at its plants and see for itself how it focuses on safety and sustainability, and how it builds its businesses based on high technology. In 1910, it went into a business which is not related to explosives. It started focusing more on the chemicals. In 1937, it innovated a new silk made of chemicals, and it was the first completely man-made fiber. And it built its engineering works, and it built synthetic elastic capabilities. Lycra is a famous brand name of DuPont, and various other medicinal inputs were also provided by DuPont in its rich history. The suits that are worn by Apollo were made up of materials made by DuPont. Between 1970 and 2021, the company moved into electronic biomedical instruments, and it acquired several other companies to make itself more diversified. Charles J. Pedersen, a retired DuPont chemist, won the company's first Nobel Prize for the discovery of chemical compounds called crown ethers. It's focused on research in chemistry and chemical engineering. The first integrated biorefinery in the world was set up by DuPont. It also diversified into food business. It acquired Danisco, a food ingredients and enzymes company from Denmark. In 2015, a watershed moment occurred in DuPont's history when DuPont and Dow entered into a merger of equals with the intention of creating three independent companies. The Dow-DuPont Specialty Product Division, however, continued to carry the name DuPont. DuPont separated the nutrition and biosciences business, and as part of the transaction, N&B merged with IFF. That's where DuPont stands now. There are three businesses, as I said, and total revenues grew from $20 billion in 2016 to $23 billion in 2018, and later to $24 billion in recent times. They exclude Corteva and Dow businesses, which were split off in second quarter of 2019. Electronic and imaging was one of the bigger businesses, so was nutrition and biosciences. One of the important characteristics of DuPont as compared to any other industry was the focus on sustainability. DuPont took up safety and sustainability as one of its major business visions, and also as one of its major businesses itself. So there are three aspects of DuPont's sustainability framework. Innovations to thrive, that is, create sustainable solution to society's most pressing challenges. Sustainable operations deliver world-class end-to-end performance in safety, resource efficiency, and environmental protection. People and well-being enable the health and well-being of the people and communities and advance diversity inclusion globally. DuPont believes in innovation in business. Essential innovations are delivered across the three businesses: electronics and industrial, mobility and materials, and water and protection. In the electronics and industrial field, DuPont is a technology leader. It serves the semiconductor, circuit board, display, digital, and flexographic printing, as well as healthcare, aerospace, industrial, and transportation industries. The list of industries which use DuPont materials is indeed vast. In the area of mobility and materials, DuPont offers high-performance engineering polymers, resins, adhesives, specialty pastes, and films. They enable material system solutions for the most demanding applications and environments, and the industry range is very extensive: automotive, electronics, industrial, consumer, medical, photovoltaic, and telecom industries. Water and protection is the third vertical where DuPont has got strong business focus and technological depth. DuPont's expertise spans high-performance fibers and foams, aramid papers, non-woven structures, water purification technologies, and protective garments, and includes well-known brands such as Kevlar, Nomex, Tyvek, Styrofoam, Korean, Great Stuff, Filmtech, and Taptech. DuPont played a major role in the all-new electric London black taxis. By no means DuPont was an automobile manufacturer, but it had certain technologies in bonding of structural parts and glass to structures in such a manner that it could develop a lightweight extruded aluminum body structure, fully integrated, not with nuts and bolts, but with comprehensive bonding and adhesive solutions. So for meeting all the challenges, DuPont came up with a solution called Bitamate product solution. It helped reduce the substrate thickness, reduce the weight of the car, and eliminated the need for mechanical fasteners. It integrated all parts of the TX5 lightweight bonded extruded aluminum monocoque body in white. Through bonding, the chassis, brackets, posts, roof, and fixed glass became a unified structural unit. It could bond the car body as well as the SMC, body panels, and door skins. All gaps and finished seams were filled properly with the chemicals, DuPont chemicals, and it helped prevent moisture intrusion, and corrosion was nipped in the bud. And it also provided acoustical and thermal management benefits for the car. DuPont may not have been an automobile company, but it helped create an all-new electric black taxi for London. DuPont also made several investments to address health challenges. It came up with the Livio brand healthcare silicone solutions that had lots of product innovation and manufacturing capability. DuPont Livio helps in three market segments. In biopharma processing, it enables cost-effective, safe manufacturing of biologics used in innovative drugs and vaccines. Livio pharma tubing and overmolded assemblies help in that. There are also pharmaceutical solutions that enable effective new therapeutic drug delivery routes with a unique offering in topical and transdermal solutions and gastrointestinal drugs. Medical devices are made safer, more convenient, and more effective. And for that, a broadening range of specialty medical adhesives and elastomers were developed, and that supported the trend for connected devices and wearables. Creating value through innovation has been one of the greatest visionary planks of DuPont. It balanced risk, efficiency, and sustainability. It believed in triple bottom line: profit, people, planet. From value extraction, it has now moved to value creation. In the past, it just had only value protection. So operational risk management, governance and compliance, stakeholder engagement were the risk management skills and behaviors. Efficiency was brought in through sustainable value chain, sustainable capital, and operational excellence. It released value from the operations. Employee engagement was promoted and cultural change was effected. And today there is a high level of organizational maturity which is focusing on value creation. So from value protection to value extraction to value creation, DuPont has taken a significant step towards the triple bottom line of sustainability. Profit, people and planet matter a lot together, an equal measure for DuPont. The DSS Innovation Management Framework is unique to DuPont. It sets the business strategy based on innovation, open innovation, external networks, powered by market insight and foresight capabilities on one hand and core competencies and technological capabilities on the other. And this is supported by a capable and motivated organization with innovative and collaborative culture. As a result, a portfolio and pipeline management system has been established which led to strong results. Ideas and screening, project management and post-launch management were key parts of execution. There are several transformative technologies in the making at DuPont. I'll only talk about three aspects. One, electronics convergence. Emerging technologies are being utilized for miniaturization and speed. Increasing power density and frequency is the hallmark of the new electronics devices from DuPont. Advanced packaging is offered for high-performance devices. Digital acceleration involves artificial intelligence and machine learning. Big data and predictive analysis is used in a big way at DuPont. There are smart technologies and connected devices already under development at DuPont. There is also a multi-material system integration endeavor. As we have seen, DuPont is very strong in materials technology. Safer, more durable, more reliable, higher performing products are coming up. Advanced hybrid and electric vehicle technology is also being provided by DuPont and application-specific expertise in material selection. DuPont has embraced sustainability goals in a strong and sincere manner. DuPont sustainability goals for 2030 are the following: zero hunger, good health and well-being, clean water and sanitation, affordable clean energy, sustainable cities and communities, responsible consumption and production, and climate action. DuPont's 2030 sustainability goals are helping to shape our innovation agenda and process, how we innovate, which markets we prioritize, and how we collaborate internally and externally to fulfill our purpose. We designed the goals to be challenging, to provoke technological breakthroughs and new ideas for addressing society's biggest challenges. Now our innovation teams are working to determine how we will do it. In order to thrive, innovations are being deployed and they are in synchrony with the United Nations Sustainable Development Goals, SDG. Within the 17 SDGs, the company has identified 7 with the strongest alignment to science and markets. And DuPont is confident that they can impact change at scale in those areas. The first is transforming wastewater into drinking water. Second, through sport racing, to ensure that the mainstream automotive industry gains from the niche products. For new expectant mothers, reducing emissions in transportation. These are the 4 leading aspects of the DuPont innovation outlook for the future. DuPont's innovation goals are in terms of 3 layers: innovate, protect, and empower. Under the innovative theme, we have delivering solutions for global challenges, enabling a circular economy, and innovating safer by design figure prominently. Under the protect basket, we have acting on climate, leading on water stewardship, delivering world-class safety and health performance figure prominently. And in the empower group, we have accelerating diversity and inclusion, cultivating well-being and fulfillment, and building thriving communities as the goals. So we have a set of 9 goals across 3 innovation streams. DuPont revenue consistently has been around $21-22 billion over the last few years, and like several other companies buffeted by the adverse trends, it also registered a loss in 2020. Now DuPont looks to focus on 3 sustainability areas: creating a sustainable innovations platform, increasing the sustainability profile throughout its operations, ensuring the inclusiveness, well-being, and health of people and communities. To commit to sustainability and innovation is to align 100% of its innovation portfolio with the UN Sustainable Development Goals. And DuPont believes that by linking its technology to Sustainable Development Goals, it would help the world as well as help itself. And all products in future will be designed by using sustainability criteria. And in order to implement the green chemistry principles, it will accelerate the adoption of safer alternatives in the marketplace and also have safer processes in all of its operations. And it would like to stay away from the linear take, make, dispose models to restorative and regenerative approaches in its sustainability and innovation. It also wants to contribute in terms of reducing greenhouse gas emissions. It is acting very quickly and it wants to reduce greenhouse gas emissions from its infrastructure by 30% and procure 60% of its electricity that is required for its operations from renewable energy sources. And by 2050, the company hopes to achieve complete carbon neutral operation. For this, DuPont is investing in projects which reduce greenhouse gas emissions, and it is committed to implementing Paris Agreement's commitment. Sustainability at DuPont is not just about mitigating downside, it is about creating lasting positive solutions and value for customers, stakeholders, as Senior VP said. The mindset also creates the urgency and imperatives for our scientists, business leaders and marketers to solve for our customers and the society now. This is the full list of DuPont sustainability goals, from aligning 100% of the company's innovation portfolio to meaningfully advance the UN Sustainability Development Goals and create value for our customers, that being the number one, to circular economy principle and various other aspects of sustainability. There is a specific target as well. It wants to improve over 100 million lives through targeted social impact programs. DuPont would like to hold itself accountable. Alexa Dembeck is the company's Chief Technology and Sustainability Officer. She says, our goals are designed to have measurable outcomes. Some have quantifiable targets, while others create frameworks to improve the ways we operate and innovate. We pledge to transparently report on our progress toward our goals, including reporting to CDP and publishing an annual sustainability report that follows the GRI standards framework and the UN Global Compact. We will also continue to publish our public positions on key issues and engage in constructive dialogue with interested stakeholders. That is the self-accountability which DuPont would like to have on itself. These are the key notes relating to DuPont. Thank you. We'll meet in the next lecture.